So in this chapter, what we're doing here is we are applying the competitive model, which we just learned about. Um, we're applying the competitive model to look at things such as welfare, meaning how much better off is an individual by participating in a competitive market than they otherwise would be, and looking at producer surplus. How much additional revenue are they going to get versus the minimum amount they would have been willing to accept? Okay, so let's get into this. So again, we're going to look at consumer welfare, producer welfare, and then just generally look at this idea that basically the general conclusion here being that economic welfare in general, which equals the sum of consumer surplus and producer surplus, is maximized under perfect competition. Essentially, what we're seeing here is the reasoning why, in an ideal world, we would have only perfect competition. Prices are lowest. Then you've got consumers who are paying their reservation price. The highest price they'd be willing to pay. And essentially that there's a maximized difference between the two. And then the same for the firm, that there's a um, price that is low, but is still higher than the minimum price they would have been, than the price they would have been willing to accept. Okay. So, one of the things that we had seen in the last chapter was this idea that, again, firms shut down in the long run if they're making zero profit. What that would require us to also look at is to look at the opportunity cost. What could the firm do otherwise with the resources that it's employing to produce the product? And what we would see is that instead of saying that a firm is making zero profit in the long run, rather what we should say is that they're making a positive profit, but that positive profit is no higher than what they could have done otherwise. And essentially, when the firm is making zero profit, sorry, I'm repeating myself just because I briefly paused the video. Um, if the firm is if the firm is not shutting down and it's operating in the long run, it would be earning zero profit. But it's not like it's earning zero profit in actuality as a dollar amount. It would be earning a positive dollar amount, but the amount of that positivity above zero is equal to the opportunity cost of how they could have used those resources elsewhere, meaning that the zero economic profit is basically a normal business profit, which again would be positive, but just not any different than what they could have earned in other industries. And so we could see this here, right? That we could imagine a scenario where the person um, producing charges a price, marginal revenue equal to their marginal costs, where here the profit is equal to the rent. But, right, if they rented that out, if they rented those inputs out to others, they're really not earning a profit because in this case, um, we could imagine that they would get back exactly that rent by renting it out to others. Thus, the economic profit would be zero. So, despite earning, despite the fact that in the long run, that the accounting profit is positive, the economic profit is zero. And by that we mean that the opportunity cost is equal to the accounting profit, or essentially what we would call normal profit, normal economic profit. And thus we see here that the firm is still operating to maximize its profit. It's just operating in a way where its economic profit would be zero. So let's now look at consumer welfare. And what this reflects is a difference. So think back to principles. Think back that far. And there we had an idea. Let's actually insert a new slide here so we can kind of see this a little bit clearer here. Oh, yeah. Can I make it just blank? Yeah. Okay, let's get rid of this one. The idea for, in principles you may remember, is that it could have a supply and demand curve, but that each of these points on the demand curve are known as reservation prices. And that reflects my maximum willingness to pay as a consumer. But to just think of someone here as being like incredibly passionate and wanting to buy something in the very beginning. But the price they pay is just the equilibrium price. Thus, there is a difference between the reservation price and the price actually paid. And we could sum that up across all of the quantities purchased until we get up until we get an amount that looks like this, which is the consumer surplus. Same for producers, right? Producers have a minimum price they're willing to sell it for. And instead they receive the equilibrium price, which again creates a difference between the two. Now, that's not profit, but it does create a difference between the two. It's not profit because we're not really talking about fixed costs or anything. And so that difference is called the producer surplus. So here we've got our consumer surplus and our producer surplus. Okay, let's go back to the slides here. And so essentially what we're seeing here is that difference between the two. The difference between the maximum amount they would have been willing to pay and the marginal value, which is just essentially the price. And that creates for us a graph again that you've probably seen in your principles textbook, which looks like this, where consumer surplus is measuring the difference between my reservation price, the highest price I was willing to pay, versus the price I actually paid. We could sum up those. eBay is a perfect example where, right, if you're doing bidding, the person that really, really wants to buy the thing is going to bid an incredibly high amount, and they'll win it, right? And that can be very different than what the price would have been if had there been an equilibrium price. The way that an auction is designed is such that the person winning the bid has no consumer surplus. They paid exactly what they valued the good for. So there we go. It's the consumer surplus. Our definition here would be the monetary difference between what they were willing to pay for the good versus the price that it actually was. And seeing a different way, this would be the difference between where the demand curve is versus the equilibrium price. What would change for that consumer surplus would be if we change the equilibrium price, right? So we can see that here. If I do something that raises the equilibrium price, then the consumer surplus is reduced. It's reduced by both an amount here, this area B, that's transferred presumably from the consumer to the producer. But it's also reduced by this little triangle here. And that little triangle here is what we refer to as the deadweight loss. The loss in surplus, the loss in consumer surplus, created by the fact that less is produced, because we're going from 1.25 to 1.16. The 23.2, we don't really, economists don't really have any problem with the 23.2. That was just a social decision that just altered whether consumers got it or producers got it. But the 0.9, that's a deadweight loss. No one gets it. The consumer lost it, but the producer didn't get it because that amount wasn't produced. So it's just lost. Hence the reason why economists generally don't like price controls, because they, in essence, create deadweight losses, as well as taxes. And so the size of that deadweight loss is going to depend a lot on the elasticities. For instance, we don't want to really, most of the time, you don't really want to impose taxes on medical, on housing, on transportation, where they are more inelastic. Because, in essence, what you're going to do is you're going to force people to, you're going to reduce the consumer surplus a great deal more than if you pick things that are more elastic, such as clothing, such as alcohol and tobacco, presuming that you're not addicted to either. Because if you're not addicted to alcohol and tobacco, then essentially what you would do is you would just consume less of it as the price goes up. Thus, the change in consumer surplus wouldn't be as significant. So what this brings us to then is this idea that if we had two linear demand curves and one of those demand curves was less elastic than the other, then where would we have the larger consumer surplus loss? Well, we could visualize it and see. And in visualizing it, we would see that the more inelastic demand curve would, generally speaking, have a greater loss in consumer surplus than the curve that is flatter, or the one that has a more elastic demand curve. Thus, leading us to the general conclusion that we should try to tax elastic goods rather than inelastic goods. So, taxing things like plane tickets or concert tickets or buying new furniture, as opposed to taxing schooling or medical expenses or prescription drugs, which in almost all states is not taxed, except the state of Hawaii, where we impose an excise tax on almost everything. Okay, now what about the producer surplus? Again, that's our difference between the amount they would have been, the minimum amount they would have been willing to accept versus the price that they actually received. Or graphically speaking, it would be the area above the supply curve up to the price. And just to jump ahead here, and you would see that here, that the producer surplus is the area above the supply curve up to the price. All right, then we're just kind of equation-wise, we would just see this here where the producer surplus is equal to the revenue minus the variable cost. Okay. So again, we could make kind of a simple calculation here. How much producer surplus would be lost when the price is falling? So again, now we're going to see the transfer of this rectangle from producers to consumers. But what we're seeing now is that the quantity is going to be changing, right? In this case, the quantity is changing from 1.16 to, 1.16 to, 1.25 to 1.16. So as that price is falling, then consumers are capturing area D, the rectangle, but because now only 1.16 is produced, consumers aren't going to capture area E. Area E is now just lost. Again, a good reason for why, generally speaking, we would try to avoid taxes and price controls that manipulate the market such that consumers and producers share in a portion of the deadweight loss. So there we go. Our total economic welfare is then simply the summation of our consumer surplus and our producer surplus. And that leads us to our general conclusion that under perfect competition, the economic welfare is maximized. Meaning that if I have my graph here with supply and demand, that this entire large triangle is the economic welfare. Anytime you try to limit that with taxes or price controls, you reduce the economic welfare. And again, what becomes important is not the transfer from one group to another. That doesn't matter. Really, to economists, to an objective economist, it doesn't matter who gets what. Economists kind of care, obviously, as they get more like entrenched and care more about particular groups of people, like consumers or producers. Like if you're an economist for hire that represents the producer, then obviously you're going to care. But for the most part, you're not going to see a significant change between the two. You're not going to see a significant change bothering economists. Economists are only going to become concerned when the deadweight loss emerges. And the size of the deadweight loss is really important what I'm saying here. The size of the deadweight loss, the height of the deadweight loss triangle, which is essentially determining its area, is completely determined by the elasticity. You've got the definition here, but let's look at the graph here so it makes a little bit more sense. Notice how this area, okay, so in this case, the output went down. We don't know why, it just it did. Okay, so it went down from Q1 to Q2. As the price went, as the price changed, right, in this case, the price must have gone up, then area B was transferred from consumers to producers, because now it's the area above the supply curve to the new price. But the deadweight loss, which is the gray triangles here, C and E, has a height determined by the amount of change from the old quantity to the new quantity. Now, if you look at this very carefully, you will see that area C is not the same as area E. Looks like E, if you're just kind of quickly eyeballing it, it looks like E is a little bit larger than C. And all that is essentially doing, or what that's essentially, the reason why that's the case is essentially because there are different elasticities of demand than supply. They're not equal to each other. So in this case, the supply must be a bit more inelastic than the demand curve. And so when we look at ways in which economic welfare could be reduced, again, one of them is by the height of that deadweight loss, the amount of change from the equilibrium point. But it's also the case that welfare can be reduced, economic welfare can be reduced when we produce too much, where the cost of producing it then exceeds the value that the consumers give to it. That would be a market failure as well. A market failure is really any time that the price is not equal to the marginal cost. And here, what we're saying is that the marginal cost is exceeding the price. When do we see this in reality? We see it in agricultural products where we produce so much that it ends up having to be dumped. For instance, we make too much cheese because we're trying to support dairy farmers, but then it ends up that we can't all buy all that cheese that's being produced. I'm just going to jump here to what the picture looks like. That way you can kind of see what I'm talking about here. But essentially, if we required people to consume Q2, then we would have a loss the other way, where the deadweight loss is area B. An interesting case that I was reading about today. So what is today? Today is March the 11th. And right now, as you know, the state legislature is meeting and deciding certain laws. And there was one where the state legislature wants to increase the level of minimum insurance that people need to buy for their cars. I mean, obviously, it's interesting in a number of ways, but sorry, I interrupted the video there. So I'm probably going to end up repeating myself here for one moment. So again, this is the graphical, at least, representation of what it looks like to have the deadweight loss on the right-hand side. Now, typically, again, when you've looked at problems in principles class, we've talked about the deadweight loss that's generated by the reduction in the production levels. Here, what we're seeing is the reduction, at least in total economic welfare caused by overproduction. It doesn't happen as often, but again, usually the special cases are usually for a social purpose, such as providing too much agricultural product support, or protecting other industries that a country might feel proud of, and thus we could have overproduction and even overconsumption of that product. Okay, but again, we've seen these before, and that's kind of what's described here. Is that typically it's government action? I'm not trying to be political here where I say it's the government. Yeah, it's not that. But it's usually, if we let the market theoretically operate as it wants to, we would be theoretically at efficiency and at equilibrium. When the government gets involved, it obviously doesn't necessarily know what the equilibrium level is, or isn't happy with what the equilibrium level is, and thus takes action such as price controls or taxation to change the equilibrium price to something that's a non-equilibrium price. And as you change it to a non-equilibrium price, we then impact the welfare, meaning we impact the consumer surplus, the producer surplus, and create deadweight loss as well. The barriers to entry. Now, this is important. The barriers to entry become important when we're talking about the long run, and the idea that only a normal amount of economic profit would exist in the long run. Because otherwise, what happens is a much higher profit level would be sustainable for a long period of time, or a loss would be manageable for a long period of time. Instead, as we see that entry and exit, the profit and loss levels get adjusted until we're at the point where we're at normal economic profit. Sometimes there are these barriers to entry are explicit restrictions, right? So the government, again, controlling who can be an airline. But other times, what we're seeing here is that it's a cost that's a hindrance to starting something. And we can see those here that there can be large sunk costs. These are large sunk costs where either the firm has to raise a lot of capital to start the new business, or the level of success is so uncertain that one doesn't want to even take the risk to make the investment. Then when we turn to sales taxes, is another way that the government can push things out of equilibrium. We can see that a new sales tax, obviously, we would remember from principles that the sales tax can cause the reduction in both consumer and producer surplus. That loss, most of it does get transferred to the government, but it's also the case that we create the deadweight loss. Let's just, we can look at this here, but let's just jump to this here and then I'll go back. So here we can see that we had remember there's a legal and an economic incidence of the tax. The legal incidence is usually binary. It's either all on the seller or all on the producer. And there's a few exceptions to that. For instance, our Social Security tax is split up between the two. But for the most part, legal incidence is most of the time going to be on the seller because it's easier to track. And here we can see that here, that we've got legal incidence all on the seller. What the economic, so legal incidence means who's going to be responsible for actually turning over the, amount of taxes to the government. The economic incidence is how is the consumer surplus and producer surplus affected. And here we can see that the tax is areas B plus D. Consumer surplus lost B, so now it's only A. Producer surplus lost D, now it's only F. But again, the idea here is C and E represents the deadweight loss. Now let's go back to the slide that we skipped here, which essentially is what we see here, that the total welfare would be consumer surplus plus the producer surplus plus the tax. So in this case here, B and D. And going off of my memory, which isn't too good. So the idea here is that the total surplus would be A plus F plus B and D. But if we compare it to what it was before the tax, was A, B, C, D, E, F. After, it's equal to A plus B plus D plus F. Thus, we can see that the difference between the two is C and E, which is our deadweight loss. Okay. Now, you can tell I don't look ahead at the slides. I kind of just wing it. Well, dude, this is the clean way of it looking. Now, what is important about this is that you can calculate this, and which is what we will do on the problem sets, where you would calculate areas of triangles by 1/2 base times height, and you would calculate the area of rectangles by length times width, which would mean that you would need to calculate y-intercepts, for instance, for a supply curve and a demand curve. And then we can obviously solve something where we have a demand curve and a supply curve, and we need to calculate the deadweight loss. And we're given two scenarios, one where the demand curve is a bit more elastic than the other. And we basically have to look at what would be the tax consequences of that kind of event happening. And what we can see here is that when it is more elastic, what we can see is that the change is a lot different. And so here, sorry, I had to pause there, but so here what we see is that the more inelastic the demand curve, then the smaller the change in the smaller the change would be in the amount of tax revenue, right? So in this case, the reason why well, in this case, it's also a little bit different. So notice here the supply curve is completely elastic. And so with this completely elastic supply curve, what we're seeing is that by imposing the tax, the producer surplus increases by areas A, B, and C when we're with the elastic curve, and by A, B, C, D, E under the inelastic curve. But in both of these cases, also what we see though is that the quantity is reduced, either reduced to quantity 2 or quantity 3. And so what that does is it then changes, right? We've got this change now of the amount of tax that's coming in. With the tax imposed, we now would change, right? A, instead of now going to the producers, A goes to producers initially and then becomes the tax revenue. Areas B and C for the elastic curve, B, in this case, does end up going to producers, but C is still lost. And under the inelastic curve, B and D would go to the producer, but E and C would be lost. E and C being the deadweight loss. Now, what if we see this again, this tax? How do we see all these changes happening? Again, graphically, when we look at this, we can see the same sorts of things here. In this case now, we have a subsidy, right? So in this case, this subsidy is basically a negative tax, which now shifts the supply curve to the right instead of the left. But again, even the subsidy does create for us a deadweight loss. A deadweight loss of area E. And that's what we start to see here. Right? That if we start to, let's see here, A through G. Okay, so let's get this out here. So what would be the consumer surplus before? Consumer surplus before was A and B, which is what we see right here. Producer surplus would be the area above the supply curve to the price. That'd be areas D and G, which we see right here. Government revenue was 0 because there was nothing going on. So total welfare would be A, B, D, G, adding up consumer and producer surplus. Now with the subsidy, what you see is that D and E and D and G are going to producers and consumers. D, the subsidy, and E, D, and G. Because remember, the producer is going to be receiving that subsidy per unit sold. So ABDE, ABDG, what are they gaining, right? The difference, which would be D and E and B and C. to their D and G. So if we go over here, B, the amount of the subsidy additional, and C. Now look at C. C didn't exist before. So now this is being captured by the producer because now they're selling 1.34 billion row stems instead of 1.25 times the 11 cents, which is our area C. But again, it does all ultimately result in deadweight loss because after the tax, which is basically being captured from consumers and producers to some extent, we still are left with F, our deadweight loss right here, which shows that even under a subsidy situation, we can still end up worse off. Instead of taxes, we can alternatively see this as a price support, which is basically a price control. In this case, if we impose a price floor, which is what this would be, a price that's set artificially above the equilibrium. Now, essentially what we see is the alteration of the consumer and producer surplus and the deadweight loss. Where is it all? A, B, and C before the floor, A after, A, B, and C before the price floor, just A after, so B and C are lost by the consumer. And then for the producer, it was E and F. Now it's just E. Right? A, B, C, E. Now, what we're seeing here, though, E and F. But then what we're seeing here is that that E space still exists, but, right, the E space still exists. B was transferred from consumers to producers. But now we've got a little bit of a problem. We've got C, D, and F. So what do we do with these spaces, right? These spaces, now what we see is that C was lost by consumers and is now transferred to producers. F was lost by consumers, transferred to producers. What about D? So now if we look at this here, D is actually going to go to the consumer because now we are going to see more being produced, right? So now we've got this change here because at this price, this much is demanded, but this much is supplied. So the area above the supply curve to the price would be this entire region, B, C, D, E, and F. B and C were transferred from the consumer. D didn't exist before. So D's got to come from somewhere. Because what we've got going on now is a surplus, right? We've got more being supplied than demanded. Someone's going to have to buy that. Which is going to have to be the government. The government's going to have to step in and buy that difference. And that's what we see here. Just skipping ahead here, just in a little bit of a cleaner space, what we end up with is that deadweight loss. The deadweight loss now exists on the right-hand side here with this price support. And we saw that over here, right? Our deadweight loss was basically captured by the government. The government basically subsidized it. Here, the deadweight loss is a bit more problematic because no one is buying up that difference. Instead of through a price floor, we can see it all through a price ceiling. That would be a price that's set artificially below the equilibrium price. such as over here, where again, if we do the comparison of consumer and producer surplus, we can see it right here. I'm not going to go through the detail. I'm assuming we're all good with that. Okay. We got free trade restrictions. I'm going to not worry about that because we're not going to be covering that, tariffs and quotas. You're certainly not going to see it on the exam. The final thing I just want to attach to here is this discussion of rent seeking. And this would be, we see this quite often in competitive markets where individuals spend a great deal of money in order to gain a particular advantage. And that behavior called rent seeking is also inefficient. Okay?